You're live, ma'am.
Thank you. Good morning. I am calling the Investment Committee of the Alabama State University Board of Trustees to order on May the 5th, 2025. We will have our invocation, please, by Trustee Madison.
Yes, ma'am. Thank you. Let's bow together for a word of prayer. Father in heaven, we come this morning. First of all, we just want to say thank you for your continuous blessings. Father, thank you for allowing us to come together this morning to conduct business on behalf of Alabama State University. Father, it's our prayer that you will bless each participant in a special way. And Father, we just ask as we continue to do this work that you be in the midst of it. And we ultimately want to give you all the praise, glory, and honor. In Christ's name we pray. Let us all say amen.
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 Thank you. We will now have establishment of a quorum. And in the absence of our Board Secretary, President Ross, Ms. Jones, are you able to do that, or I am happy to?
Yes, ma'am, I can.
Thank you.
Chairwoman McKenzie,
Present.
President Dillard, President Dillard, President Pro Tem Madison,
Here.
Trustee Bracy, Trustee McCord. Madam Chairwoman, according to our list, you do have a quorum. I don't think the president has come off mute, but if she can just acknowledge that she is here, you can start your meeting.
Well, considering our next item on the agenda is the adoption of the agenda, which does require a vote, we will skip that because this meeting is primarily informational anyway. I don't anticipate having to take any actions today. And I do see that Trustee McCord has just joined. So please let the record show her presence.
It is indicated.
Thank you so much. I appreciate you joining. So we are down to the investment update, and that's primarily the purpose of our meeting today. The investment committee is a relatively new committee that has been formed.
I think that is correct. I know that will be the big kickoff of the day, so I haven't.
Okay, thank you. Relatively new. Thank you. And President Dillard has noted in the comments that she is present. But the investment committee is a relatively new committee of the Board of Trustees. You know, we'll talk about at our retreat some organizational ties that we need to wrap up. But for today's purpose, we wanted to convene the committee and have direct interaction with Neuberger Berman for them to present to us an update on the investment portfolio. Now, I do want to ensure that we are clear that at each of our finance committee meetings, Mrs. Pritchett does give us an update from the reports that are received, and she does share the quarterly reports with us that we send on to the board members. But we also want to ensure that we have direct interaction with Neuberger and have the opportunity for the investment committee, as well as any trustees, to have questions answered and clarity provided for any of the activities that are being managed under Neuberger. So with that, are there any questions, trustees, for our purpose today? Then hearing none, I will turn the floor over to Andrew White and Xavier Peoples to walk us through our investment update, our portfolio update.
Perfect. Thank you. Hello, everyone. Forgive me for not being on screen. I'm in the process of traveling. But as always, here at Neuberger Berman, we want to thank you all for entrusting us to manage your portfolio. We count it an honor and a pleasure, and we love working with the great institution, Alabama State University. On today's portfolio review, Andrew will cover the state of the market. As you know, with the first 100 days of President Trump's presidency, it's been a kind of turbulent time with tariffs and things of that nature. And so he's going to touch bases with that. And then he's going to talk about the overall performance of your portfolio as well. And so I would ask that you could ask questions at any point. Both he and I would love to be engaged with you all. And so stop us at any time as we go through the deck to do this portfolio review with you all. So with that being said, I would like to turn this over to Andrew White. Andrew.
Great, thank you. And yeah, I would absolutely echo Xavier's comments. Please feel free to ask any questions as we go through this. And, I know different boards like to focus on, maybe one, either performance or kind of market outlook. So we're happy to take whatever feedback you have, whether it's now or, in the future. But I can share my screen just to go through the presentation that we put together. And so, we can walk through the portfolio performance, go through the positioning of changes that we have made, and just, really talk about what we're seeing in the markets and the economy, how we're reacting to that, and how that's affecting what we're doing in the portfolio. But what I would say, just to start maybe, page 4 represents the returns of different parts of the market through March. So this is going to line up with the performance report, but does not show any of the post, quote unquote, Liberation Day moves. Although interestingly, what we've seen since then is markets have largely recovered from that initial steep drawdown. But just, looking at the market index returns through March, it was really the first 3 months of the year was a reversal from the parts that had really rallied so significantly over the past couple of years. So, I know a lot of people know that the S&P has kind of been the star of the market for a long time. And really that has only been driven by 7 kind of mega cap, really growth tech names in the US. So you may have heard them referred to as the Magnificent Seven. But for the past couple of years, they've really done phenomenal. And the other parts of the market have lagged. But when we came into this year, what we've seen is a reversal where, now you have the S&P was down 4.25%. The growth-oriented sectors of the market were actually down 10%. And all these other parts that had lagged so significantly were rallying in the first 3 months of the year. So you can see value of 1.6%. And then, surprisingly, non-US markets were up. On the developed side, they were up 7% for the first 3 quarters, and then emerging markets were up 3%. Fixed income, we're, kind of did their part in portfolios. They were a way to hedge off against that risk. You can see year to date, they were up 2.78%. So it was a mixed start to the year, but there were certainly, parts of the market that had done well and other parts that, we're not participating to the same extent. When just, anecdotally, after April, when we saw all the news around the tariffs, what I would say is everything pretty much sold off together. There was no difference in one part of the market versus the other. But now that we've seen the pause in tariffs, everything has also kind of moved up together as well. Where that leaves the portfolio is on the following pages. Page 5 is just a summary of the returns of each entity. So we'll go through this in more detail, but it's pretty clear, I would say, when you look at these different parts, obviously the income account that is much, safer, not having any market risk, was positive year to date, up just over 1%, whereas the Trust for Educational Excellence and the Pools Endowment, which have higher exposure to risk assets, were down just slightly year to date. Obviously, if you go back longer since inception, that's where you see the other, that risk-taking parts paying off, both of them up really significantly in just 15 months, about 12.25% net of all fees annualized. So there's a lot of different activity, and obviously, again, we'll go through all of this entity by entity, but we showed this flow of funds on a cumulative level. So all 3 entities, I would say really happy with the overall gain that we've seen in the portfolio. So starting off the relationship in November of 2023 with 116 million, about 8.6 of that has been taken out. But when you combine everything, portfolio up just over $25 million in 15 months. So getting off to a really strong start overall. If we look kind of entity by entity, starting off with the largest, the Trust for Educational Excellence, what I would say is we can go through this one in a little bit more detail, because our goal and what we've done so far is we manage this pretty identically to the pooled endowment. So although we have sections for each one, they really are going to mirror each other. So I'll spend more time just on the trust. And start off, we have the same flow of funds, but for just the one entity. Started off with $93.5 million, excuse me, back in November of 2023, up just under $20 million in that 15-month time frame. On the next page, we can look at the asset allocation and the performance. So you'll see we ended the quarter with 28% in fixed income, 60.7% in equity, and then another 11.2% in private equity. And we'll refer to this a couple of times because, as you know, we have a 20% target to private equity, but that's something that we want to build over time. So, we've gotten to 11.2%. We would look to close that gap to the 20% target over the next couple of years. But pretty balanced allocation, and the ending market value for the quarter was $99.7 million. I mentioned, there has been a pretty significant rally post the steep drawdown that we saw right in the beginning of April. So just for reference purposes, the portfolio is now just at about $101 million as of the close of business on Friday.
Hey, Andrew, just one quick reminder. What is the as of date of your report? Did you say March 31?
Yes, correct.
Okay,
everything
perfect.
that we have here is March 31st.
Thank you.
Sure. So the net performance numbers are below. And just a reminder, I know we did discuss this the last time we were meeting, but what we're trying to do is, in a way to simplify this to some extent, there is the parts of the portfolio on the fixed income side, and then the middle section of equity that are all publicly traded. We receive prices for all of these on a day-by-day basis, and the same thing for their corresponding indexes. On the private side, it's a little bit different, where each of the funds are valued on a quarterly basis. The index is valued quarterly. They're usually received with about a 1-quarter lag. So for a lot of these, for example, we might be just now in May receiving 12/31 valuations. So there's always a lot of mismatches on the private side. And so to make sure that we have an apples to apples comparison, what we want to show is first, kind of your total portfolio. And that's what's represented by this first column here. But then what we also want to do is show the portfolio performance if we remove all of the private equity. So something that isn't, as influenced by the lags that we're receiving on those marks, something that's a little bit more up to date. So we also show the total portfolio X private equity, and then we compare it to an investment policy index. Again, the same thing. This one includes the private equity benchmark. The investment policy XPE obviously doesn't include private equity. And what I would say is just kind of, we're always going to show both. We're going to review both. But what I would say is for shorter term time periods, think, quarterly returns or even less than 1 year, I would focus more on the X private equity composite. When we look back, on a longer term basis, and certainly since inception, that's where it may make more sense to look at the total equity or the total composite. So just to go through the numbers, and we'll go through some more detail, but portfolio has gotten off to a terrific start. So up net of all fees on an annualized basis, up 12.38%. On the year to date, despite a lot of the drawdowns that we've seen, what I mentioned with the steep drawdown on the S&P, because of the balanced nature of the portfolio, it was down just 29 basis points for the first 3 months. But, so very happy with those returns. A little bit more disappointing when we compare it towards the benchmarks. So as another reminder, the main benchmark that we're comparing ourselves to is this investment policy benchmark. And that is reflected of all of the underlying indexes for the different asset classes that we invest in. That is tailored to your risk and return goals. It's meant to design to meet those return goals that we have. And we look to beat that benchmark over time by both our tactical positioning. So are we overweighting an asset class? Are we underweighting one? And then also through the selection of all of the underlying strategies that we employ in the portfolio. So are we going to an active manager that we think is going to outperform the index over time, et cetera? And we really, the goal over time is to beat this benchmark. And so as happy as we are with the absolute performance, we are a little bit disappointed, I would say, in the fact that, we have trailed the benchmark over time. But what I would say is we're not really changing anything that we're doing. We have conviction in what we've done, why we've done it. And we think that's really will pay, will show a benefit over time. But I'll go through in more detail kind of why we're seeing a little bit of that, underperformance to that investment policy, the index. And that's maybe just quickly before I go through that, what I would say is on page 13, you can see our positioning for how we ended the quarter with the current allocation versus the target allocation of that investment policy index. And the biggest kind of divergence, what I would say is, again, on the private equity side, where you do see almost a 9% underweight to private equity. So, because these are funds that we're committing to over a multi-year period, they're going to periodically draw down capital. We know it takes time. We don't want to rush into this. We don't want to be overexposed to, one part of the private equity market or one fund. Because of that prudent approach, we're doing this over time. And because we have that 9% underweight, we have to determine how we want to allocate that. So, what we've done is we've tried to be balanced of mixing it between both equity and fixed income. We know just because we're underweight, we still need to meet your return goals. So that's why you see we have about a 5.7% underweight towards equity. But we also want to ensure that we're not taking on too much risk. We want to make sure that we have liquidity available for any withdrawal needs or when these private equity funds start to call capital. So we also have another 3.1% overweight to fixed income. So 28.1% to fixed income versus that 25%. So really just trying to be balanced. We don't want to be too overexposed to one area of the market versus the other. We know there's a lot happening in the markets, but we think this balanced approach is really the right way to be allocated for right now. All of these decisions that we make, again, the allocation and the strategies that we have in each of these asset classes are going to drive the portfolio performance. And I know there's a lot of numbers on here. Again, feel free to ask any questions, but really what this page is meaning to do is to kind of simplify the relative returns. So when we show our portfolio performance versus an index, it's very clear to say whether we underperformed or whether we outperformed. But this is trying to isolate the decisions that we make and what's driving that underperformance or the outperformance. One thing I'll mention just as we go through this, and I apologize, I know this can be a little bit confusing, but the numbers don't exactly tie out to what we show on our performance reports. What I would say is the performance reports they're the true numbers. They're our audited numbers. That's what you should be going off of. This is just meant to give the high level, what's working and what's not working. And the columns that you should focus on are this allocation effect and the selection effect. So really the allocation is, again, where have we been overweight and underweight and how has that impacted performance? And then the selection is really trying to see how are the strategies performing versus the index. And what we want to do is, we look at this on a quarterly basis, we look at it annually, and just try to, again, what's working and not working, but also, is there anything that we should be doing differently in the portfolio? We may have conviction in the managers that we have, but if they're really underperforming significantly, we have to kind of take a deeper dive there, see if there's anything that we should be doing. And frankly, what's just as important is if during certain times we see really big outperformance, really meaningful outperformance from kind of one decision that we've made, that's great. But that could also be maybe showing signs of risk that we don't want to take, and we use that as an opportunity to reposition. So that being said, just thinking about what's happened in the first quarter. So, I mentioned we did underperform by a couple of basis points. And when we look at this at the total level, the reason for the underperformance was our overweight towards the equity asset classes. And so, I mentioned we're about 5% overweight to equity. Because equity markets have sold off a little bit, that's what drove down our relative performance to the investment policy index. And that's why you see this negative 29 basis points and all the different kind of components here of equity detracting. What's positive and did offset it to some extent is the performance of the underlying strategies in the portfolio. So when you look at all of the different equity categories that we have here, all of our mixes of managers in each asset class actually outperformed. And so, we're obviously very happy to see that. And that's really important because what I would say where a lot of these managers should really be showing their benefit towards clients, towards investors, is when things are selling off dramatically, that's where the active management should really come into play. And we saw that this quarter. So, large cap, the performance of the strategies here at 18 basis points, 1 basis point from small cap, and then both developed and emerging markets. So, disappointing to show kind of overall underperformance, but happy that the managers were proving their worth for this quarter. If we look back towards since inception, here I would say it's kind of the exact opposite. So where we've taken on, a little bit more risk because we have the underweight to private equity. And apologies, I should mention, as I was going through this, shorter term, we're looking ex private equity. So that's why you don't see that line item here. But as we go back to the longer term timeframes, we are showing the private equity component. And the underweight to private equity did detract about 1%, but we more than offset by that by adding towards these other equity categories, looking to see where can we generate the overall return that's needed for your portfolio. We were able to do that. Our tactical positioning really did add benefit since inception. That's why you see the 78 basis points here. But what was struggling was the performance of the managers really concentrated in U.S. equity. And this goes to what I had mentioned with the concentration issue. So really going back for a longer time frame, but really post kind of COVID, there was 7 names in the index that had done phenomenally well. I'm sure you've just heard of them, again, the Magnificent Seven. And a lot of the active managers that have had exposure to these names, but just not at that same really extreme levels of concentration as the index, have really kind of lagged behind in this time frame. And so as things have shifted in in 2025, it's been a benefit. But since inception, they did very well overall, but just did lag the benchmark. So what's been hurting us is the performance of these U.S. equity managers. And I'll go through that when we actually look at the strategy line items. But maybe I'll pause here. I know I went through a lot. I was trying to cover, so why we're looking at this, how we're compiling it, and what the actual numbers were. So happy to take any questions. And I know as much as I went through, it seems a little odd to say this is meant to simplify the conversation, but really that's what it is. You're looking at the total effect of, both of these columns.
Trustees, are there any questions at this point? Okay, so Andrew, just bear with me for a moment. Oh, I have a
Sure.
couple of questions. So when you talked about the comparison of our performance to the investment policy benchmark, and
Yes.
I don't know which slide it was, but understand that the benchmark is the standard. Yep, that's the page right there. So
Yes.
would the uncertainty around the economic state that we have seen over the past quarter have been factored into that benchmark?
Yes, it would have. So really what this is on this page, on page 13, you can see all the different asset classes that we allocate towards. You can see the target allocation to each of those, and then the corresponding benchmark. So what the investment policy benchmark is, it's made up of 3% the cash, 15% of fixed income, or investment grade fixed income, excuse me, and all of those different parts. So as, for example, as the S&P has sold off, that is reflected in the benchmark. And really what I would say we've been a little bit more cautious since inception. Things have done very well, but there's been a lot of different concerns and a lot of different things that we're watching that has caused us to be maybe a little bit more patient. If we had taken on more risk, we would have outperformed, but we've tried to be a little bit more patient, especially at the beginning.
No, understand that. And then I don't remember the slide you were on, but when you talked about the overweight of the fixed income and equity, I think in order to plan
Yes.
for the investment needed for the private equity, that's just the act of balancing the dollars where we think are safest for the need that we have in the future. We don't
It's a mix.
It's a mix because are you saying that we don't necessarily know when the private equity needs may ramp up? It's the nature of the maturing of that business, right? That they may need capital.
Right. It's a mix of, overall, regardless of where we allocate, we still need to meet your return goals.
Yeah.
And so we can say we're underweight private equity because of A, B, and C and all these different reasons. And, we certainly think that's prudent, but we also know we still need to meet your return goals. We can't use the underweight to private equity as an excuse. So that's why we have part of it towards equity, because we know over longer term time periods, that's where you will generate the return.
Mm-hmm.
But, we also don't want to take on too much risk. And if we get notice that you need liquidity or withdrawal, we want to make sure that we don't have to sell down equity in a down market. Or again, as you mentioned, if private equity does start calling capital, we want to make sure that we have that available. And to that point, what I would say is, I know on the private equity side, it's so hard for us to time that, but also when you see a lot of these more stressed periods in the market, that might be where these private equity managers are finding a lot of opportunity. So we just have to ensure that we have the money there to meet those capital calls.
Okay, that makes sense. And still, this is March 31st. And to your point, the market has rebounded a bit, and that would show through in our April into May numbers.
Correct. And so I have we show the trust year to date was down 29 basis points through March. I have here kind of unofficial audited numbers. So we'll see how it actually turns out, but the portfolio is up actually around 1.5%.
Okay.
Through the close on Friday. So it's been pretty remarkable. As bad as the first week or two were of April, it's bounced back pretty significantly.
Okay, thank you for that.
And so maybe I can go through maybe quickly when we rebalance portfolios on a formal basis quarterly. We have an asset allocation committee that meets every quarter. They determine where the best opportunities are, where there's risks. We make sure that we're implementing that in your portfolio. But we review this constantly. And what we did for this quarter is we had our views for the second quarter in kind of April, but things were obvious. They were selling off so dramatically. They were selling off so indiscriminately. We didn't want to really take on a lot of activity in those initial drawdowns. We were not attempting to time a bottom or really just market time in general, but we didn't want to do too much activity in the first week or so. But in the kind of the second week of April, we did use all of the volatility as an opportunity to add equity back to the portfolio. So if you compare this current allocation towards the post rebalance, in the middle of April, we added about 2% towards your equity column. Again, you can see increases in the different parts of the market, but it was such a dramatic drawdown, and a lot of the fear was centered around just basic uncertainty. And I'm happy to go through this more when we look at the outlook, but once there was announced that there was going to be a pause in tariffs, that potentially there could be a lot of negotiation around these, especially with more, countries that are more our allies, that provided a little bit of a bottom to the market. So we wanted to take advantage of that, and we did add equity back into the portfolio, as you can see here, about 2%. And then on page 17, we show the kind of the dollar amounts that went in here. This is probably a little bit hard to read, and I apologize. I know there's a lot of numbers, but it was just over $2 million we put into the equity markets in the middle of April. The final thing I'll say on the portfolio, unless there are any questions, just to point out some of the manager line items. On large cap, we've taken a very kind of low cost, somewhat passive-like approach to this asset class. But as an example of how much the concentration issue was hurting manager performance, on our research opportunities portfolio, you can see it lagged the benchmark by about 1.5%. This was almost all due towards not owning Tesla. So Tesla was up close to 60% in just the fourth quarter alone, based on nothing more than Elon Musk's relationship with the new presidential administration. We thought the valuations were extremely high. It's not something that we wanted to own, but just not owning that one name caused some pretty significant underperformance. Interestingly enough, as we got into 2025, Tesla sold off dramatically, and now the fact that we didn't own it was responsible for some meaningful outperformance. So just kind of shows that reversal that we've seen in 2025, and that more disciplined approach, I think, really benefiting and hopefully will make up some of this ground over time. The one part of the portfolio that I would say we're more disappointed in, and we're really taking a deeper dive, is in our small cap managers. And here, for a lot of our clients, this is part of the portfolio that has provided the most outperformance, but really disappointed with, I think, how some of these managers have been doing on a relative basis, especially in the down markets. So if you go back since inception, we've seen some underperformance here and managers not really performing in line with our expectations. The small and mid cap strategy has obviously rebounded, really started to outperform, but the small cap intrinsic value continues to lag. We hasn't changed any of our conviction in these strategies. They're not going to be something that we want to sell out of, but we are looking at other kind of alternatives of maybe something that we can add to offset some of this underperformance. We don't want to just kind of sit idly by and not react to what we're seeing. What I would say is when you look on some of the other parts of the portfolio, whether it's large cap, where you can see the very lowest cost ETF here, we also have some ETF exposure in non-US markets. But in the small cap part of the US market, 40 to 50% of the names in that index do not generate any or even have negative revenue. So we don't want passive exposure here. We don't want to own all parts of the market because there is so much junk there. We do think that, a more risk managed, patient approach will pay off. But just to be, very honest, we haven't seen it so far. So we're just looking to see if there's anything that we can do here. And probably by next quarter, you may see a addition to this part of the portfolio. Private equity, I'll just, because of the lag in reporting, as I mentioned, now we are starting to see some of these marks come in, and you can just see even though they are lagged, providing some benefit to the portfolio as when markets have been selling off, you've seen, a couple of these portfolios exhibit positive performance year to date. Only thing I'll mention quickly on the pooled endowment, as I did say, we're trying to manage this kind of identically. There's always going to be some level of differences. The only thing here, happy to say, at least since inception on the pooled endowment, we're actually ahead of the investment policy benchmark by 1 basis point if we go back towards since inception. But there's really nothing meaningful I would point out here that is not the same as the larger trust. And then for the income account, this is all really in kind of a cash managed portfolio, up just over $800,000 since inception, and 5% annualized going back to 2023. Last thing overall, we always want to show the fees for the different parts of the portfolio. So this is for each entity. I know there's a lot here. We do this to try and be as transparent as we can, line item by line item. The main takeaway is a circled part down here. So for the 3 different entities on a combined basis, it's 67 basis points all in. That's any and all fees that are being charged, which we think, still is really attractive. When you look at the different parts of the portfolio, you're going to see, maybe some things that jump out a little bit more. We know there are parts that are more expensive, and if we think that they are adding value to the portfolio, we don't want to not allocate there just because they are a little bit more expensive. What we'll look to do is offset that by adding towards really low cost options, whether it's, again, the Vanguard S&P, which is just, 3 basis points, or other ETFs, that what we're trying to control is this overall total fee level that you see down there. We want to be respectful of the time. I'm not sure if there is more on the agenda. I'm happy to go through a market outlook, but I'm not sure how much time we have left.
Trustee McKenzie, I'm interested in the market outlook.
Okay, yeah, we'll get there. We do have a stop at noon, but that is definitely part of what we want to talk about, as well as some of the tools and opportunities for us to be engaged directly with Newburgh as they give this information to a broader audience. So continue on, please.
Sure, absolutely. So I'll go through this, and I mean, there's so much going on in the markets, and I would say I could probably easily cover it in 2 minutes or 2 hours. But every indicator that we're looking at right now, there's such a wide level of uncertainty around it. You know, whether it's employment, GDP, inflation, interest rate policy, company earnings, it is all a little bit up in the air right now as we're kind of in this wait and see approach around trade negotiations and, you know, potential impacts. And sorry, I'll just move ahead one page. But what I'll say is, you know, certainly tariffs were not a surprise. When you listen to the administration on the campaign trail, they talked a lot around tariffs and looking to correct kind of what they were viewing as longstanding trade imbalances. But what really took the market by surprise was the size and the magnitude of them, how they were calculated, and you know who they were calculated against. It seemed a little bit indiscriminate whether it was China, which both parties have been talking about putting tariffs on, or our closest allies. And also the fact that there was a lot of hope and maybe looking back on it, naive optimism that the administration would put to start a lot of their more pro-business or pro-growth agenda items first. So, you know, things like deregulation and tax cuts, they would kind of put them in place first, and then they would come out with a little bit more of aggressive trade policy. But that's obviously not what happened. And so I think that's why you saw such a steep drawdown, and the drawdown that affected all the different parts of the market. It didn't matter what company it was, what part of the market, or, you know, sector, industry, or even country. Everything basically sold off together, you know, very dramatically. And because of what the market is always going to trade on, you know, the worst thing that they could have is uncertainty. If they came out and just said, we're going to put, you know, extreme levels of tariffs on China, companies would look at it and say, okay, do we want to pay these tariffs or have our, you know, our customers pay it? How is that going to affect pricing? How is that going to affect demand? If they move it, you know, factories to another country, that all goes into this calculation of supply and demand, and the market would figure that out and react. But when there is the level of uncertainty, that's why you see such dramatic moves. And really, you know, we did a lot of work going into this around what could be the potential impacts of tariffs. We kind of said it, you know, maybe a 10% tariff rate would slow GDP, but we think that the economies would be able to handle it. What it is right now is closer to a 20% rate. And, you know, we continue to hear talks around negotiations and that being brought down. But what I would say, regardless of any negotiations, it's very clear tariffs are going to be much higher than they have been, you know, certainly historically. When we're trying to, you know, price in what we think the potential outcomes will be, certainly we see the U.S. economy, which was the envy, you know, globally, kind of growing north of 2%. We do see that coming down probably to just around 0.5% GDP growth here in the U.S. So a pretty meaningful drop, I would say, but importantly enough to avoid a really true and deep recession. We think the economy will be able to grow very slightly. When you talk to any other economist, and, you know, we're always talking to economists at other firms, other research firms, but I would say it's kind of right now about a 50-50 toss-up if there's going to be a recession in the next 12 months. When you look at growth outside of the U.S., I would say you start actually to see some signs that where, you know, everyone has been so focused on the U.S., you are starting to see signs of growth in, you know, Eurozone GDP, Japanese GDP, as expectations are starting to rise a little bit, they don't have the same level of inflation that we do have here in the US. And this idea of, one, the US not being the only game in town, there are other parts to invest is providing a little bit of a relief to those markets. And also, certainly when you look at an economy like Germany and just the Eurozone in general, they've really been relying on the US being their source of defense. And, not a political statement, but if that's not going to be the case any longer, what we're seeing is a lot of these economies start to build out their own defense systems or to start to do a lot more stimulus to their own economies, and that's providing relief. So we do think that there are opportunities outside of the US, as that relates to our positioning. That's really where we're starting to put a little bit more money, shying away from those mega cap growth names in the US, adding more towards Eurozone economies. And I think we're trying but overall, we're really trying to be patient. What you're seeing is us trying to stay in line with clients' long-term investment policies targets, because we don't want to take a large bet one way or the other. Certainly, there's a lot of risk in the markets right now, whether it's a delay of trade negotiations, which are notoriously long and take time to play out, or just when you've seen such a significant rally like we've seen over the past 3 weeks, you can see a drawdown. So we're not trying to get too exposed to risk assets, but when we look at our kind of medium-term outlook, we think a lot of this trade rhetoric will die down. There will be negotiations. We think it will be more focused on kind of the true country Trump and his administration are trying to go after, which is China. But that will provide a little bit more relief to the markets and more potential for those other parts of their policy enactments that they're trying to do, such as the tax cuts. As the market starts to price in some of that, we think that's going to be another source of relief when we look out a little bit longer term. So despite some of the concerns that we have more near term, we don't want to take a lot of those equity positionings off the table. And that's why you kind of see more neutral positioning across the board, whether, fixed income, equity in general. And what we're going to do is when markets, if they sell off dramatically, we're going to do what I went through and what we did in April. We'll put money back in the equity markets. What we're doing now is, as there's been liquidity, there's been a couple of capital calls, and we're trying to now trim those parts that have rallied so dramatically over the past couple of weeks and just kind of stay in line here. Try and use that volatility to your advantage. When, if you're working with an individual who may be getting closer to retirement, you can say, you can always say, oh, you want to buy low and buy when people are panicking, but it's harder to do for some clients. But a portfolio like this, which is meant to be, kind of perpetual in nature, use that volatility to your advantage. And what I would say is we're probably expecting to see an increase in capital calls on the private equity side, as they're going to use a lot of dislocation to their advantage. And also what we're going to try and, what we try to do is, as private equity funds come out, they fundraise for a long time. So you don't actually have to make your commitment right away. From an operational perspective, what we've tried to do is say, any commitments we want to make in any given year, we'll send the paperwork at one time just to try and cut down on your burden. But we are finding opportunities now, and we will be making our commitments for 2025 soon, because there is going to be opportunity that we want to take advantage of. And on the private equity side, specifically, and you might have seen this in some of the news, a lot of investors have really put a lot of money to work in private equity for all the reasons that we've talked about. They've been able to get higher levels of return, et cetera. They want to use that long-term time nature to their advantage. But what we've seen is a lot of them, frankly, did way too much. And if you look at a Harvard or a Yale who have done so well, they're at about call it 50% private equity. They have about another 30% in things that are really illiquid. So what they have to do right now is they're almost being forced to sell off their private equity holdings because they don't have liquidity to meet their needs. That is why we don't, we're not saying to do 40% of their portfolio there, but also why we have allocated towards what you've seen, one of your strategies is called a secondary fund. That's where we're going to be looking to do another one. What that does is that goes into the market and that buys secondary, more or older private equity funds from clients that need to sell them down. And just think about anything, if you have someone who is forced to sell because they're in a stress period, that works to your advantage because you can pay a lower price for that. If you know someone needs that liquidity, you can pay 80, 90 cents on the dollar and buy these things at a discount because you have the longer term time horizon. You're underweight private equity, whereas most investors are really overweight. So, again, to keep using the same frame, but use that to your advantage and the longer term time horizon to your advantage. I'll pause there, take any questions. There's a lot of information that we can go through. I know there are, kind of broader calls that this will, the different thought leaders at the firm will go through. So we can certainly share that with you. I'm happy to stay on the line even after your other agenda items if there are questions, or we can even have another one-off conversation if that makes sense as well.
Thank you very much, Andrew. There is, to your point about a broader call, it has been shared with the committee and all board members, quite frankly, of the economic outlook you have scheduled for Wednesday, May 14th. Trustees, you have the opportunity to register for that call if you so desire. If you don't think you have that email or that information to do so, please let me know because I feel like we've sent it out to everybody. And there are periodic conversations like this that Neuberger puts on. We want to be sure that we are able to join those. And so with that, I've had a conversation with Xavier. He's gotten me plugged in. I do have one question. For these, are we able to register for these individually so that we're notified as the next one is coming up? Or do you need to distribute this to one person and we get it disseminated out amongst the team?
No, that you can join individually.
Okay, perfect. So trustees, I just
And
encourage.
there's also replays.
Okay, that's great. I encourage you to register for the webinars, and then you have the discretion to listen to it at your leisure since it is recorded. Are there any questions? Are there any concerns that need to come before the committee?
Madam Chair, no concerns. I just want to say great report. Very thorough report.
Thank you.
Thank you. I know I went through a lot. So definitely, if questions come up, we can go through it. But I think, over time, let us know if you want us to spend more time on the market outlook, or if you want more time in the portfolio or a mix between both. We've heard feedback in both directions from different clients. So whatever works best for the board.
That's right. We have a retreat towards the end of June. So we'll have some conversations about how we want to move forward with the investment committee, some of that. So just look to hear more from us because we want to, I think, target another touch point a bit later in the year, but it's more to come on that. Again, anything else that needs to come before the body? Then hearing none, I will entertain a motion to adjourn.
So move.
Second it.
Thank you. It has been moved and properly seconded that we adjourn the meeting. Are there any questions? Roll call vote, Ms. Jones.
Yes, ma'am. Chairwoman McKenzie,
Yes.
President Dillard, President Pro Tem Madison,
Yes.
Trustee Bracy,
Yes.
Trustee McCord.
Yes.
Your motion is passed. Your meeting is adjourned.
Have a
Thank
great
you
day,
so much.
everyone. Thanks so much.
Bye-bye. Thanks, Andrew. Thanks,
Thank you.
Xavier.
Bye-bye. Thank you.
Thank you. Okay, bye-bye.